WPTI, the Piedmont's News Talk and Sports Station. My name is Doug Ray. This is the Wealth Guardian Show. And let me once again start this show out by saluting all of our men and women who are in uniform today serving our country. I thank you so much for your service. You go in harm's way, and we appreciate that so much. You know, I'm going to go back to an old tradition I've had on this radio show since it began. And, you know, I want to thank one of my clients for bringing this up to me. He said, you know, I really miss your market updates on your show. And, you know, we've tried to do some changes with the radio program so that we're not, complacent and boring and so forth. But I like doing the market update, and I think you folks like to hear it. So here we go. Here we are at the end of 2015. Christmas is upon us. And where are we in the market? If you've looked at your statements lately and you go, I don't see a whole lot of change. Or maybe you looked at them back in August and you went, oh my gosh, I'm down 10%. Or you looked at it recently and you go, gee, it doesn't seem any higher than it was back in March. Well, you know, you're right. Literally, we are lower than where we were when we started the year by about 3 or 4%. But since that time, we have had huge volatility, incredible volatility this year. We really have not made any forward progress in the market since August of 2014. There's only a handful of you out there who have made any money in this market. Now, many of my Reynolds clients, your stock has done great this year. Count your blessings. You're amongst the rare few that's seen forward progress in this stock market. So where are we? Well, I think we're making a huge rounded top leading into the next decline. If you recall, a few weeks ago, I had my friend Tim Wood on the program. This was back right after we made the primary bear market trend change. It's a Dow theory forecasting tool. And if you want to re-listen to that show, please go on my website at thewealthguardians.com, click on the radio tab, and scroll down until you find Tim, and you can listen to that show in its entirety, because nothing has changed since then. In fact, if you recall, Tim has these 5 DNA markers he talks about that have been in place for every single major market top since 1898, which was the origin of the Dow Jones Industrial Average. Right now we have 4 firmly locked into place, and the 5th one is setting up. So where are we? Well, as I said before, I think we're treading on thin ice, so be careful out there. Make sure you've got some sort of an exit strategy in place. And if you don't, come in and sit down and talk with me. Give us a call, 336-391-3409. I'd love to chat with you and talk to you about how you can guard yourself against another major market downturn. All right, let's get into today's show. So, you know, when you think about the timing of your retirement, you think about your time. You know, for example, you say, I want to retire at age 65. That's your time. But there's another consideration regarding the timing of your retirement, and it's probably not something you've given much thought to. That's the timing of the economic cycle. Believe it or not, this could be a profound impact on your retirement. If you retire when the economy is strong, things are looking pretty darn good, the stock market's going up, then everything is really great for you. But if you retire when the economy's in the tank, or if we're going into a recession, then hold on to your hat. If you're not careful, you run the risk of losing everything. You know, a research study revealed that 2 different people with a similar amount of assets and diversification, but they retired 10 years apart. One of them retired in a strong economy. The other one retired in a weak economy. You know what happened? The person who retires in a strong economic cycle actually grows their retirement nest egg, and the person who retires into a weak economic cycle nearly loses their shirt. You can't control that economic cycle, can you? Nobody can. But there are some things that you can do to help protect yourself, no matter what happens with our economy. On today's show, We'll reveal how the economic cycle can have a profound impact on your entire life savings, plus some uncommon strategies and solutions that could literally save your retirement. All right, let's talk about a couple things that you could do right now that honestly I don't think too many people do. How about number one, have a plan. Well, what do I mean by having a plan? Have a complete written income plan. Don't just say, okay, I'm going to retire at 65 and I'm just going to shove money into a 401k until then. That's not a plan. That's effort, and I commend you for that, but that's not a plan. A plan is sitting down with somebody who knows retirement income planning inside and out, creating an income plan for you that not only grows each year to offset inflation, but is tax efficient and squeezes every nickel out of your Social Security so that you'll never run out of income for you and your family during your lifetime, and you'll never run out of assets. Now, that's an income plan. That's a retirement plan. Here's another one. Have an exit strategy. Now, if you just joined us, this is the Wealth Guardian Show, 94.5 WPTI, and today we're talking about what happens if you retire into the face of a downturning economic cycle. How will that affect you? Have a plan, number one. Sit down now and discuss with your advisor what to do if and when this market rolls over. Have that exit strategy. Look your advisor in the face and ask him this question. How do you plan? Specifically, how do you plan to protect me from another 2008? What are you going to do? What is your exit strategy? That advisor ought to be able to look you right in the eye and say, this is the plan. Whatever it is, whether they use technical analysis, a stop loss, or some other kind of fundamental indication, they ought to tell you how they plan to get your assets into a safe position before the next market downturn. Because if you're 65 and we roll into another 2008 decline, then your retirement is pretty much washed up. All right, so let me explain something to you, if I may. In this business, there's really two types of financial advisors. The vast majority of them specialize in creating wealth over time. That's what we were all taught to do when we got into the business. That's what I was taught to do when I first got into the business at Merrill Lynch. That's well and good in your 30s, 40s, and even your early 50s. But once you get to that 10 years before retirement, your focus needs to shift. And you need to find somebody who specializes in retirement income planning because the math changes completely. Now, I mean specializes in retirement income planning. I mean, there's a lot of people on the radio that say they do retirement income planning, but do they really? Do they really specialize in it? Do they have advanced designations that are specifically focused on how to create retirement income plans? Do they have that extra education in retirement income planning? We all have a license. You have to have a license, but guess what, folks? You don't even have to have a high school education to get a license to sell investments and insurance products. That's a sad thing, but it's the truth. But you have to maintain that license over time. That requires continuing education. Make sure your advisor who you work with does his continuing education and goes a step further than just doing the minimum. Heck, the minimum continuing education requirements are easy to get. You can get those pretty much in an hour and a half of sitting there reading a booklet and taking a little open book exam. Make sure your advisor is a student of his craft and knows the retirement game inside and out. And let me tell you why. I ask a lot of people, do you think we could have another 2008 again? And they say, absolutely. And then I say, well, you've lived through, in the last 15 years, two 50% market declines. What if the next one is even worse? And I'm not saying it is. I hope it's not. But let's do some math, just for fun. Let's go back to a market environment that you were not around for. Let's go back to September 3rd, 1929. The market was at 381 on the Dow. By July 8th of 1932, it bottomed at 41.22. That was an 89% collapse. If that happened this time around, our market, the Dow, topped on May 19th of this year at 18,312. If we lost 89%, the market would then bottom in 2018 at 2014. Now, back in 1929, it took it until the day after Thanksgiving of 1954 before it got back to the 1929 high. That's 25 years. Could you stand that? Can your retirement stand that? If you think not, then I invite you to give me a call to come in and sit down and let's do some serious retirement income planning. That number again is 336-391-3409. Now, another thing I'd like for you to do, I'd like for you to go on our Facebook page and like us. That's Wealth Guardians Radio on Facebook, and like us. And then also, we've got a lot of stuff on our website, on wealthguardians.com. I have a lot of information out there about Social Security, the changes that have taken place. I've got a lot of information about the sequence of return risk, which we're going to talk about when we come back for the next segment. This is the Wealth Guardians on 94.5 WPTI, the Piedmont's News Talk and Sports Station.
Season, turn, and a time to every purpose under heaven.
This is Doug Ray on the Wealth Guardians on 94.5 WPTI, the Piedmont's News Talk and Sports Station. Welcome back. What happens when you finally decide to retire and you're cold cocked by a bear market? Just like that, your entire life savings takes a major hit. How would that impact your lifestyle in retirement? What would you do? Would you eat out less? Would you give less to the grandkids? Right now, we're up at Christmas time. What would happen with your giving at Christmas if you're cold cocked by a bear market? You know, you can't predict when that'll happen in the economy, but the timing of whether you retire in a bull or a bear market could have a profound impact on your entire life savings and how long that money will last you. Coming up in this segment, I'm going to talk to you about the sequence of return risk because it's very, very important that you understand that. In the last segment, I said it's extremely important that you find an advisor who is an expert in retirement income planning because the math changes. Now, what do I mean by that? Here's what I mean by that. As I said before, most of us are taught wealth accumulation strategies, how to grow your money over time. And again, that's well and good when you're young, married, and working and creating a family and trying to save for the future, putting money into 401ks every year. It doesn't really matter too much if the market goes down 1 year or two, because what happens is, as the market goes down, that contribution you're putting into that 401k or that IRA buys more shares because they get cheaper in price. And then eventually they reinflate when the market goes back up and you've got more shares at higher prices. We call that dollar cost averaging. And I know you've heard of that all your life. But flip the scenario. Now you're retired. You're starting to take income out of that 401k or that IRA. Let's say you're drawing $2,000 a month out just to supplement your retirement. You got Social Security. Maybe you're a fortunate few that still have a pension, but that $2,000 needs to come out to buy the groceries. The market goes into a bear market stage. Well, think about it. As the bear market decreases the value of your mutual fund shares or your stock price shares, you're still having to take the same $2,000 out. What that means is you're selling more shares at cheaper prices to create that $2,000 income you need. This is reverse dollar cost averaging. This is leading into what we call the sequence of return risk. When you retire into an advancing bull market, you don't have this problem. In fact, your account may still grow even though you're taking money out of it. It's when you retire into a bear market or a decreasing market that the sequence of return risk occurs. And if it lasts more than a couple years, it can be significant. Let's go back just to 2008. Actually, it started in 2007. So let's assume you retired at the market top in the summer of 2007. Now, over the course of the next 2 years, we lost about 50% of the market. Let's assume that you're a pretty aggressive investor and you had all your IRA invested in equity in the market. And at the same time, you were taking 5% out of your account because your advisor said, hey, over time, the market average is 9%. So if you take 5% out, you'll never run out of money, right? All right, let's think about that. Between the summer of 2007 and March of 2009, the market was down 50%. You were taking 5% out, and as you took that money out, you were having to sell shares at cheaper prices. By the time all was said and done and the market bottomed in March of 2009, because of the market's effect and your withdrawal rate, you were probably down closer to 65% rather than 50%. That's the effect of the sequence of return risk. Now, understand this. In order for you to get back to even where you were in the summer of 2007, regain that 65%, you have to get somewhere north of 140% return. That's not likely going to happen. The net effect of all of this is called the sequence of return risk, and it's also called a disaster in the making for your retirement. You know, you have a choice with your money in your retirement. You can keep doing what you're doing today, or you can take control. If you take control, create a plan. All of your questions will become answers, and all that uncertainty and doubt will become confidence. Let me prove it to you with our Simplified Retirement Action Plan, and it doesn't get much easier than this. In this plan, you'll discover simple strategies to minimize your risk, transform your savings into income workhorse in retirement, how to save thousands in unnecessary taxes and penalties and fees, how to wring every nickel out of your Social Security benefits and earn additional benefits that could literally mean thousands more in your pocket every single year. Plus, you'll also learn why so many plans fail today. This customized plan is specifically designed for you and your family. This is your one chance right now to finally take control of your retirement. If you're recently retired or you're within 10 years of retiring, give us a call at 336-391-3409. I will gladly meet with you and do this Simplified Retirement Action Plan free of charge with no obligation. And of course, understand I am trying to earn your business. And if you just joined us, this is Doug Ray with the Wealth Guardians on 94.5 WPTI, the Piedmont's News Talk and Sports Station. Again, I'd like to direct you to our webpage. It's thewealthguardians.com. And on that website, you're going to find past radio shows. You'll find a lot of information up there regarding Social Security, retirement income planning. You'll find information about us, my qualifications. I do consider myself a competent expert in retirement income planning. I have done the due diligence. I've gone the extra mile, gotten the education that is critical to a successful retirement income plan. And I don't say that to be self-serving. I want you to know that because I think it's important for folks to going into retirement in this day and age to be guided by somebody who is a competent professional and and a craftsman at their work. So I'd love for you to go to our website and take a look at what all is there for you. I'm really proud of our webmaster and what they've done to create that website. Now I want to tell you a little story. I want to tell you about twin brothers. These brothers retired back in 1972. They were identical twins, and basically had pretty much went to the same school, college, graduated, but they went to work for two different companies. Now, brother number one, when he retired in 1972, he had his Social Security, he had a pension, and he had $100,000 in his IRA account. Okay? Now, brother number two, he had $100,000 in an IRA account. He had his Social Security, but he didn't have a pension. Now, let's fast forward to 1995. Brother number one and number two in their IRAs, they had the $100,000, and they were identically managed. They had 50% in stocks, 50% in bonds, and for that 23-year period, it averaged 10.1% per year. Pretty good, right? Now, in 1995, brother number one, his IRA account had grown from $100,000 to over $800,000. Really nice nest egg. Let's look at brother number two. Again, it's identical. Brother number two's situation was a bit different in that, remember, he didn't have a pension. So brother number two had to take 5% out of his IRA account to try to replicate the pension that his other brother had. All right. So if both accounts got 10.1% on average over that period of time, then brother number one had an $800,000 balance in 1995. What did brother number two have? Any guesses? Well, when I tell this story, I get a lot of, you might imagine, I get a lot of different responses. Most people say about $400,000, and that's logical, because if the account got 10 and he was taking 5% out, and we know brother number one, he didn't take anything out, but his account was $800,000. You know, one would assume about half, $400,000. Well, guess what? Brother number two was absolutely broke. He ran out of money. Why did that happen? Remember the market of the 1970s? Remember the Arab oil embargo? Remember those gas lines? We had a market in the 70s eerily similar to what we just went through. We had two almost 50% declines, and those markets killed brother number two's IRA account. Yeah, both accounts got a 10.1% average rate of return. But here's what happened to brother number two. He was taking withdrawals. And what he experienced, what your money experiences, is not the average rate of return. Your money gets something called the geometric mean. Now let me try to explain that. Let's say you got $100,000 in an account. The market goes down 50%. Now you got $50,000. The next year it goes up 50%. Now you got $75,000. But your average rate of return is zero, correct? But that's not what happened to your money. You're down 25%. Your money gets the geometric mean. I want to make sure that you folks are safe from the sequence of return risk and the geometric mean. I want to offer to everybody an account review and a simplified retirement action plan. All you have to do is call 336-391-3409. My consultation is free and there's no obligation. So once again, go to our Facebook page, Wealth Guardians Radio, and give us a like there. And until next week, this is the Wealth Guardians on 94.5 WPTI, the Piedmont's News Talk and Sports Station.